downbeat. 26 will be better than 25. Definitely ex-BSNL, maybe with BSNL as well. And there are no cancellations, etc. yet. That's coming through. There's no, I mean, it's not a big growth story. With the point with IT, there are good stories in IT as well. Coforge, for example, stocks fallen 40% from highs. But for the larger guys, I mean, heavily shorted sector, stocks have fallen. So maybe at a trading level, there is a little bit of a bounce here. So we'll see. 1.5 higher on the Nifty is what you have. The Nifty Bank is up about 1%. 1.25 now, so picking up pace. Small cap index is up 2.4%, and I think you'll have the mid cap index, which will come up 1.7% higher on the mid cap index as well. So 22,750 is where the Nifty is starting, and 50,850 is where the Nifty Bank is starting. The heat map is up on your screen, and it'll give you a sense of how we are looking. It's all green. HDFC Life is a loser. Otherwise, it's all up and about.
Absolutely. Like Nigel said, I think that's the statement of the day. We all know we'll start in the green. Yeah, where we end is the bigger question. For that, we have to wait till 3:30. Anyway, for now, Pharma is actually leading it on the way up. Sun Pharma, Reddy, Cipla, all of these pharma stocks are seeing a relief move, 3 to 4%. Maybe hoping that the pharma tariffs also get delayed. What else is higher? Tata Steel, JSW Steel up and about. There's some buying on ONGC, Hindalco. In general, the commodities universe is doing well. There's Wipro 2.5% up. Infosys, tech is rebounding. Tech Mahindra is up. Let's see TCS. Amidst this tech rebound, TCS is actually down. TCS is down about 0.25%. So the positivity isn't quite rubbing off because the commentary is subdued. There's nothing very much to take home from it. In fact, TCS is the only negative stock on the Nifty as we speak. Where are the financials? The Bank Nifty is up about 1.2%. So it's looking pretty okay. ICICI Bank is up 1.1% at this point in time. HDFC Bank is up about 2%. Kotak also higher. Most of your private sector names are up and about. Axis is very flat. SBI is also doing pretty well. So banks up, IT is recovering, but not TCS. And the global-facing sectors like pharma and metals, they are definitely having a good start.
Well, that's right. Tata Steel is in the green. They've laid out a plan to reduce costs at Tata Steel in Netherlands. And that's what could result in big, upgrades if it actually fructifies. For the time being, Investec was one stock that had upgraded the stock to hold. Earlier, they had a negative rating on the stock, so that stock is well in the green. Vedanta, that's bouncing back as well, up close to around 3.5%. You have Nalco, another metal stock that's seen a sharp correction from around, I think, 200 plus levels. It corrected to around 140, seeing a bit of a relief rally. Tata Motors is up 3.5%. Samadana Motherson as well is higher in today's trading session. Goldium, just pull up that stock. That's up close to around 15%. The reason is that US tariffs have been deferred. That's a positive development. The stock, I think, had half from the top. Remember, they get meaningful revenues coming in from the United States. So that's why this tariff deferral is actually very, very beneficial. That explains why that stock is now flying away, up close to around 15% as we speak. So a good start to trade. Metals doing well, IT is doing well, and some of these stocks like gold, I'm seeing a good relief rally. A good start, Prashant.
No, it is definitely a good start. What is happening with Muthoot? I'm just seeing. Muthoot is, on my screen, is showing a 5% cut right now.
Yes.
It is down 5%. And it's got massive volumes as well. At this point in time. Remember, on Wednesday, the stock was down 10. It ended 7% lower and is down another 5.5% as we speak. We'll try and have the management of Muthoot join us as we go along. But that is the stock on the downside that I think is playing out at this stage. Otherwise, I can't spot very much with volumes on the downside with any meaningful price move as well. I think on the upside, we've kind of highlighted bulk of what's happening. Maybe just one or two more names. Avanti Feed, the shrimp player, 6% higher. And surprisingly, we don't see it on the volume leaderboard, but it's the third largest volume name on the NSE right now. Look at that, about 400,000 shares. PI Industries, specialty chemicals, 6.5% higher on PI Industries. So 3,500 coming through there. LT Foods is up 5.5%. I think these are individual tariff relief kind of plays which are coming through. Camlin Fine, another name there in the chemicals pharma space, 12% higher on Camlin Fine, 150. So yeah, this sector, chemicals as a space, also was perceived to be impacted a little bit more than others. But here you've got some gains which are coming through.
Just one note on Manappuram, on Muthoot, sorry. I'm reading an Ambit note. They have gone ahead. They were very positive on the stock. They have turned sellers. They've cut the target price by around 24%. And they've cut the EPS estimates as well for the next few years because of the lower LTVs. They're saying that the lower, now there's a level playing field on LTV norms. That's what will reset the long-term growth expectations. And that's why they believe it warrants a D-rating. So they've gone ahead, cut big target price cut, and they've turned sellers.
So I still remember this conversation that we had with Mr. Muthoot. At that point, I mean, they had maintained that while NBFCs are not capped at 70, at that point, NBFCs weren't capped at 75%. Industry practice was keeping LTVs as high as 90%. But I remember him saying that they, in general, try and limit it to a level of banks, which is 75%. But clearly, I mean, that's not the case. The other important takeaway from these draft RBI norms is the fact that the gold itself that you're leveraging, RBI said that you have to treat all gold as 22 carat purity gold. A lot of times the ornaments that are coming in are lower than 22 carat. So it doesn't matter. You can't, overlend if the gold is not of that purity. You have to take the value as if it was 22, reduce the value, and then lend. So perhaps some of this is going to...
We'll try and invite Muthoot, and we'll try and invite the Ambit analyst as well on this, because this is the stock of the day on the downside, which is coming through. Devina Mehra is with us, founder, chairperson, and managing director at First Global. Devina, good morning. Great to have you with us here on the program. Thanks very much. Where do we go from here? What next for markets here in India, Devina, for our Indian audiences?
Good morning. So, I mean, my advice actually has not changed very much. This Monday, which was supposed to be a manic Monday, I had breakfast at a 100-year-old cafe just to remind myself that there are many things that happen which in the moment appear very tumultuous, but eventually, the golden mantra is that this too shall pass. And to some extent, I mean, India, in any case, even when the tariffs were imposed before the rollback, was relatively a little insulated, one, because we don't have that much external exposure, and two, on a relative basis, it was a possibility that you could actually be gainers because the tariffs were vis-a-vis the US and all your competitors had higher tariffs. But I mean, for the moment, that's on the pause button has been set on that. So my advice remains pretty much the same as it has been for the last 10 days, which is that if you, whatever is your equity allocation, which should never be 100%, you should remain invested. But in a steadier portfolio, if you had invested in the themes of 2024 or were overexposed to small and micro caps, you have to recalibrate. So don't try to make it up from the same stocks or the same strategy or the same scheme. That's what I always say, that just because you bought something at 100 and now it's 60, don't try to go back to 100 with that, because the market has no interest in what your purchase price was. So broadly, I would still say remain invested, because the risk of a crash for the large cap steady state is not very high, which is not to say there's absolutely cannot be any downside in the indexes from here, but the risk reward is in your favor, in the sense that the percentage the market can fall is probably less than the percentage it can rise. And when there is anxiety, when these questions come that should I pull out of the market, should I stop my SIPs, is usually in hindsight the very time that you should remain invested.
Devina, just one more question, and then my colleagues will come in. Since diversification is a big theme, and obviously at a larger level it does not change, but this is a more near-term kind of question. U.S. assets generally have seen, it's like the U.S. passport, right? Extraordinary privilege. Same with U.S. assets. Do you think that has taken a bit of a knock after what we've seen? Or again, as you began by saying, that 100-year-old cafe, this too shall pass and nothing. But then, in that sense, nothing ever matters.
No, the US, I think, has taken a knock. First of all, let's first look at the US market. So first of all, this is also a mantra I keep repeating, that the global does not mean the US. US may be the largest market, but global diversification doesn't mean that you buy an S&P or a NASDAQ ETF and that's not good enough. And while in the near term, we also think that if the US doesn't do well, nothing will do well. But if you look at, let's say, the period between 2003 to 2007, and that was the time US was not coming off a high. It was already in the doldrums after the tech crash. And yet in that 4 or 5 year period, it did practically nothing. I mean, for the entire period, it was up only 65%. Remember, the NASDAQ high of 2000 was not taken out till 2015. And in that 2003 to 7 period, the emerging market index went up 3.5, 4 times. India went up 6 times. Brazil went up 10 times. So there can be a disconnect. So that's the market part. But and US has been outperforming for about 12 years. So anyway, I'd been watching that sometime that outperformance would end. If you'd asked me 6 months ago, I would have said that, we are watching, but nothing looks imminent. But I think Trump has hastened the end of the US outperformance. And more than that, whatever US has done has hurt, I think, even on a long-term basis, the US dollar's position as the reserve currency of the world and the trade currency of the world. People will start to look at alternatives. 2 years ago, I made a video saying de-dollarization will not happen in a hurry because reserve currencies don't change in a hurry. But I think Trump has shaken something fundamental about the trust in US, because US was not just a rich country. It was a country where the world looked up to for its rule of law, its institutions, all of those things, intellectual freedom. It literally attracted the best and brightest from around the world. And that part, it is changing. Like, for example, a lot of East Asian countries did become much richer, but they did not attract the talent from the world because of all these things, that they did not have this reputation of great institutions and freedoms, which US did. So, there's some permanent damage to America for sure, but that doesn't mean that you should not, as an Indian resident, diversify, because, again, putting all your eggs in one basket is never a sensible strategy. And this is not something for a 6-month view. It is something you have to do over a period of time.
Hi, Devina. Good morning. Good to see you. When on Monday morning, people are talking about a Black Monday. I saw your tweet at that point of time, and I'd rather be with you at Cafe New York, having that delicious breakfast. That said, you've already answered a couple of my questions with regard to India or in emerging markets could outperform, and that's a possibility. Even if the US markets don't perform that well. And over the last few years, we've seen the US market capitalization as a percentage of the total global market capitalization has actually gone up. So maybe it's time for them to unwind some part of that outperformance. That said, the SIPs, we're keeping it going, and I think most investors as well, they have faith. But what would your asset allocation strategy be as of now? Because maybe in the next 12 months or so, your fixed income could give better returns than equity. Just maybe, that 8 to 10% return or thereabouts. So what will your asset allocation advice be to a lot of our investors?
I normally say that don't change your asset allocation too frequently, because it's very difficult to time that. So it is usually a good idea to decide broadly on your asset allocation. Don't tinker around too much with it, because what you end up doing mostly is chasing the last asset or last strategy that did well. So that's what you will end up doing. And that, if you do it systematically, you systematically bring down returns. So we have, like for equities, all these calculations that this is how equities compounded for 20 years, 30 years, I'm talking even for India. But if you look at the mutual fund data, you will find that most people do not remain, majority of the people, more than 50% of the people do not remain invested for more than 2 years. So that's the data. So that's what causes the actual underperformance. As I said, the time you are asking, the time to ask this question actually usually is when you are absolutely gung-ho and you think that the equity markets are going to do brilliantly, which was the case for most of 2024, let alone small investors. I had family offices coming to me, saying that, why are you so risk averse? We want to take high risk and get high returns. I said, only thing certain with high risk is high risk of losses, high returns are not guaranteed. And the other was that no, we don't have extraordinary expectations. We'll be happy if you give us 30-35% compounded.
Wow. Devina, I'll be
When you are in that mode is when you should probably look at cutting back. And sentiment is always a contraindicator. Again, studies around the world have shown it, not just in America, but every continent, every country, this study has been done. It shows that sentiment is a contraindicator when there is fear, anxiety, question marks. Then the next period returns are higher. And when everybody is gung-ho, the next period returns are lower. So that's how it goes.
Devina, I'll be very happy with that low to mid-teens returns. I keep my SIPs going, most of what I earn. And people say, Nigel, you didn't see 2008. I don't want to see it also, and I hope I don't have to see it. But probably this could be the best phase to build a longer-term portfolio. So that's my hope.
Absolutely. Devina, you said it, I think. That's going to be the new reality check for a lot of newer investors. I'm hearing that in some of my friend circle as well. Market doesn't go up. And the idea of, 12% returns compounding being good returns, that idea is very alien and very new to a lot of the youngsters who came to the market post-COVID, right? But we'll see. The market is the best teacher, they say, and I'm sure people will learn.
They say you're smart if you learn from other people's mistakes, but at least learn from your own mistakes.
Absolutely, absolutely, Devina. Great chat. Thank you so much for joining in. You have a great Friday, and we'll connect again soon. Well, we're staying with the market. By the way, it's about a 380-point up move right now. It's a nice market in cruise control mode, at least right now. 22,770 on the screen. Nilesh Shah is with us from Envision Capital, of course, to get some more perspective in. Nilesh, it's dizzying, it's crazy, it's up one day, it's down another. Within one night itself, it's, so many different cycles. But my question is that now that there is this 90-day pause, and we know his mind has shifted, he's understood that you can't completely destroy markets, Mr. Trump. Do you think we're past the worst?
It's hard to say we've passed the worst because clearly there's so much of volatility. Every day, decisions come, new decisions come, previous decisions change. So till we do not get to a stage where countries sign up on these bilateral trade agreements, it's always going to be hard to kind of really say whether the worst is behind us. But I'd at least say that the kind of uncertainty which has unfolded in the last few days, and the fact that the markets have already kind of been on a consolidation or a correction mode for almost now more than 6 months, I'd say that a fair bit of the damage is already done. I mean, I haven't seen the sentiment as bad and so many words of caution coming in versus what we have heard in the last maybe 3 to 4 years. So to that extent, I'd say a fair bit of the damage is done. In fact, maybe investors run the risk that if there is basically a final settlement to this chaos, you're going to be caught off guard. So clearly, I believe that a fair bit of the damage is done. Valuations are turning attractive. It's just more now getting into more of the bottom-up mode to kind of build a more long-term portfolio. So I'd say that, yes, a fair bit of the uncertainty is behind us, but you can never say that it's entirely over.
Sure. Nilesh, one specific question on IT services companies. And we've discussed this in the past. You're obviously very bullish on digital and internet businesses. But traditional IT services, I mean, look at TCS. I'm not getting into what they did in Q4 or not. And Q4 was their worst quarter in FY25. But even if you look at backdated numbers, in FY23, the company, this was just after COVID, company, came off 13-14% kind of growth. FY24, TCS grew at 3.5%. You can argue there was base effect over there. This year, it's ending with a growth of 4%, minus any tariff or global uncertainty. How should investors look at the IT exposure they already have in their portfolio?
So if you're not a benchmark indexed investor, you're not hugging the benchmark, then there's actually no reason for somebody to be in the large cap IT space. And this is not just a recent phenomena, but clearly with the huge base effect, even if I were to kind of look at it for a very long period of time, when the US has been on a roll, technology spending has been quite phenomenal, our large IT services companies have probably been growing in mid to high single digit, at best 10% in local currency. So if you actually remove the currency depreciation, the growth is even lower. So clearly, these are businesses which probably have been growing at about 5%. And you kind of mentioned that data point even for the most recent times. But I think that's true for a very large part of the last 5 to 10 years. And I don't see this changing meaningfully unless any of these companies do a very big pivot. And I think they've now grown just too big that I think it's going to be very difficult for them to do a mega pivot. So to that extent, unless you are a benchmark kind of oriented investor, honestly, I think within the world of IT services, there are many more other bottom-up opportunities in the tier 2, tier 3 space, which are doing some really specialized work. So that should really be the focus segment. I would probably think of the large cap IT to be more like kind of a value play, where you suddenly see it too beaten down, you want to participate in the market, maybe at some point of time it becomes a good value play to kind of buy into and maybe hold it for the next 6 to 12 months and see stock prices go up and you exit out there. But beyond that, these are single-digit growth businesses. Of course, these are fabulous companies, the kind of capital efficiency they deliver. So they are great companies, but probably not great investments.
Absolutely, and I think I put it right there. Nilesh, hi, morning. Talk to us about one or two bottom-up ideas. You know, it's been so much macro last few days. But it's at the end of the day, if you're going to make money, you've got to buy some stocks, right? And I think it'll be helpful for our viewers if you can. Just, of course, with full disclosure. Yeah.
Yeah, without getting into individual names, but clearly, Prashant, I think the 2 or 3 opportunities where I'm still kind of extremely excited about, and they've got nothing to do with a global slowdown or a global recession or anything to do with tariffs, but clearly, one is the whole digital space, and there are plenty of fintechs out there. There are some of these consumer internet companies, which I think continue to kind of do well. No matter how much of bashing that we do around food delivery or quick commerce, but this is really probably the fastest growing segment that we have in India. Clearly, payments is again a very, very exciting opportunity. Clearly, where the whole...
I think Fino payment is... I mean, if you allow me, is that name? Which you like? I mean, you already own it.
What we own are both Fino Payment Bank and Paytm. These are the 2 companies that we own. One is a bank, the other is essentially a payment platform, but getting into essentially a whole range of financial services. These are 2 businesses that we have been owning for some time, and we continue to really like their long-term prospects. And these stocks prices have corrected meaningfully, without any kind of an impact from a US slowdown or this whole tariffs thing. So they're clearly domestic-driven opportunities where penetration levels are low and the growth potential is quite massive over a medium to long-term horizon. So these are some of the spaces that we like.
Just very quickly, a follow-up on payments, Nilesh. You would have seen this, right? One of the regulatory issues that came out from the monetary policy was finally RBI saying that maybe we should have MDR for UPI transactions now, at least large UPI transactions. They're still, I think, considering it. They'll figure it out and decide how it needs to be shared between NPCI, merchants, etc. But could that be a big kicker for a stock like Paytm, or do you think it will be only marginal at the periphery?
No, it will be a very big kicker. It will be a very, very big kicker. And the company had also been guiding that they would turn EBITDA positive in the quarter gone by, and maybe at some point of time, they would also turn basically positive at the net earnings level. And I think clearly one of the things that will drive that will be basically the ability to charge MDR to large merchants. And that's going to be massive, because currently it's not that through other modes of payment, the merchants don't pay MDR. They do pay MDR for credit card transactions, and those numbers are quite meaningful, quite significant. So anybody who has a business which is relevant for merchants, and especially for millions of merchants, I think that's a big kind of an opportunity. The other essentially is the optionality that they sit on, that when you are serving payment products to millions of merchants, you essentially can cross-sell many other financial services products. And a start has already been made in that direction. But basically, there is a significant optionality that is sitting out there. So these are the kind of businesses which I would probably think are relatively immune to the current, the not so favorable external environment.
All right. Hi, Nilesh. Good to see you. And as always, Nilesh, for this week itself, the FMCG/consumption pack has made a comeback. And normally in times of uncertainty, the FMCG/consumption index has done better, barring this time around, because in the last 7 to 8 months, it's actually underperformed what the Nifty has done. What's your view on this sector? Because it's got some tailwinds. Commodities have crashed, so packaging cost will come down. Demand is expected to come back because Indians will have a high amount of disposable income. So that's the hope out there. And at least as of the recent predictions, the forecast suggests that the monsoon is going to be pretty okay. Your view on this theme?
Clearly, consumer is likely to outperform. I think it's very well poised to outperform. I clearly believe the roots of that were laid out on the 1st of February when the massive tax exemptions were extended to India's growing middle class. So clearly that was the first trigger. And second is now basically the crash of crude. Clearly augurs very well for them. That's going to help them to expand gross margins and the operating margins as well. And that's been a space which is not done so well in the last few years. So I think it's poised for a fair bit of outperformance. And the trick is going to be to essentially identify select categories. I mean, of course, there's a broad consumer staples as a category, and businesses around soaps and maybe shampoos probably are relatively more mature and are highly penetrated. But some of the other emerging categories like beauty, personal care, feminine hygiene, maybe dairy products, that's really a segment which is still very, very early in terms of the penetration. And those are the kind of categories which will witness significant acceleration in the years ahead as India grows and as the average Indian becomes more aspirational. So clearly, consumer as a space is poised for some really decent outperformance.
So, Nilesh, what's the final advice? I mean, if we talk about, okay, let's say the next 12 months, right? 12 months, how much do you see the market rising? And let's not take Nifty 50, let's broaden the scope, even if it's a Nifty 100, but at a broader, index level, what do you see ahead next 12 months?
At the cost of going wrong, Surbi, but I would think that basically the markets would be higher from where we are today. I clearly believe over the next 12 months, a lot of this dust would have settled. I would expect, the government of India and the policy makers to unleash the next round of reforms. Third, inflation is trending lower. Interest rates would essentially be lower. And some of the most recent policy initiatives will begin to play out over the next 1 year. So I clearly think, and on top of that, I expect foreign investors to come back, given the kind of headwinds that they see in the United States. I would see increased allocation for emerging markets, including for India. So I think on the whole, be it fundamentals, be it liquidity, or be it sentiment, a combination of these three things, based on that, I would expect the markets to be higher a year from now versus where we are today.
All right, and Nilesh, on that positive note, we'll leave it here for now. Thank you very much for coming on this morning, talking markets and what you like in the markets at this point. We take a quick commercial break here. A very interesting and special conversation with Najib Shah coming up. He's former chairman of Central Board of Excise and Customs. Last time we spoke with him, we were in the middle of the sort of entire reciprocal tariffs bit. Actually, we spoke to him the day after the reciprocal tariffs were imposed. So what next in terms of India-US negotiations? Coming up. Welcome back. I think we're approaching the 2% mark on the Nifty, and it's looking good overall. We started with about a 1.25% gain, tentative, but things have picked up since. Now, noted American economist Jeffrey Sachs has warned India about getting closer with the US at the expense of its ties with China. He was speaking with my colleague Shireen Bhan. He said India should not be anti-China to please the US to try and get a better trade deal. Listen to it.
Market capitalization in 2 days, you're probably on the wrong track. The United States is on the path of wrecking the world economy once again. This is not U.S. policy. This is not congressional policy. This is not U.S. public policy. This is Donald Trump's policy. He is single-handedly wrecking the world economy. And I think the damage is going to be done before it gets undone. India really needs normal relations with China. And India should appreciate this is a great civilization, and this is a country that's going to play a huge role in the world in the 21st century. I mean, a huge role in the world on all sorts of things, on culture, on economy, on technology, on global peace. Yes, have good relations with the U.S., but don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement. It's the end of American leadership, I would say. It's the end of other countries looking to the United States as a stabilizer, as a rule-based order, although that was quite frayed already, but now no one could utter those words with regard to the United States. Similarly, China was not in any way isolationist. It was the major trade partner of probably 150 countries in the world. But China has aimed for the last decades to be a responsible participant in the international system. China now has to take a more leadership role. I think China will have to enable the renminbi to play a more international currency role. It's been very gradual, step by step, but I think it's going to have to accelerate.
Well, those are strong views, and of course, I mean, those things will play out over a long sort of period of time. Of course, Jeffrey Sachs has maintained some of those views for a while now. They're not new. But that wrecking the global economy, maybe that wrecking ball has been sort of reined in for now with that 90-day pause. We have Najib Shah, former chairman of Central Board of Excise and Customs, now joining us. Mr. Shah, thank you for joining us back on the program here. Prashant this side. We've been talking about global economy and world trade, etc. But now it's a pause which has come through. And I think Scott Bessent did mention a list of countries that the US will negotiate first. You know, there was Japan there was Korea there was India there as well, right at the end. What should India do now in terms of trade negotiations? And where is it? It's a very fluid kind of situation. But just give us what you think.
I think the Indian negotiators is in a very unenviable position because US has repeatedly now shown that it can disregard trade agreements. Canada, Mexico, South Korea, Australia are all examples. So this is one thing we need to constantly keep in mind. Having said that, the fact of the matter remains that the US market is important for very many of our exporting products. So, and mind you, any free trade agreement, if we were to get into with USA, will open up a whole host of non-tariff barriers. And in the latest USTR 2025 report, has a whole litany of grievances about India's non-tariff barriers. They have concerns about our imposing our BIS standards. They have concerns about our government procurement policy. They have concerns about our IP and host and so on and so forth, about our rates, of course. So they will be pushing for all these. Agriculture is a major area of concern for them in their non-tariff barriers. Now, are we willing to open up all these sectors? And these are sensitive sectors for us. So I personally feel going into a bilateral trade agreement, while it is a good option forward because it doesn't violate the MFN WTO principle, with a country like USA, it will, right at this juncture, will be difficult. We need to identify products. The EU has done that, identified products where it feels it can reduce its tariffs and work towards convincing US that this is the markets you wanted, we are reducing the tariffs there, and we'll take it forward from there. The bilateral trade agreement itself will follow all these things. But remember, when we reduce the tariffs, it has to be MFN. It should not be US specific. It should be across the board for imports from all countries. That is what will be advisable. The Indian importers have to, Indian manufacturers have to be cognizant of that. We have to be cognizant of China coming in a big way. Again, we should not forget that China is the #1 country as far as all our safeguards and anti-dumping duties are concerned. So we should be cognizant of the impact such Chinese imports, which can follow a reduction in general duties across the board.
You wouldn't read this pullback, this pause as a bit of, it's a reprieve, right? And they're kind of pulling back from an extreme position. You started by saying Indian negotiators are in an unenviable position. But in a way, US has kind of given in. I mean, they're not saying 26% now. It's a baseline 10 and then to be negotiated. Of course, 10 is higher than where they were earlier, but you don't see it like that.
You see, when we were at 26, we were happy that we had a comparative advantage vis-a-vis our competitors. That advantage has been done away with now. We're all at 10. And Indian exporters will find it difficult to compete with Bangladesh and China, whose cost of production perhaps will be lesser than India's. Bangladesh and Vietnam, I'm sorry, not China. China, of course, has this, 125, 145, depending on what you want to look at. The comparative advantage which we thought we had has been wiped out. So while this may be a reprieve, it's not the end of the road. There's still a long way ahead. The uncertainty will be killing for the Indian exporter and the businessman. What should this pricing be? What should this costing be? And how much will the government of India be able to support in terms of whatever the drawbacks and the remission of duties, which the schemes which we have? How much can we support to make sure that the goods continue to be competitive?
Mr. Shah, the other thing is with now a full-blown trade war with China, and that obviously also can be, that there can be a thaw there, and we'll see how that pans out. But for now, it looks like, 84% tariffs, 145% tariffs, it's a full-blown trade war there. And if it kind of stays at that high level, Chinese goods need some place to go. Our Indian tariffs, you briefly said, most of our sort of, barriers are aimed at Chinese goods. Do you think across industries it's sufficiently high, or we'll need to be on guard there as well in terms of second-order impact because of US and China?
We will need to be on guard. China has historically been should I say, found to be depressing the cost of the products, which is why anti-dumping and safeguards have kicked in. So we need to be on a safeguard. When we are going to reduce our rates of duties for US as part of our bargaining chip, and I suggested that it should be uniform across all imports from all countries, then we have a situation where the Chinese goods can enter in again in a big way. Dumping can be a possibility. So we need to negotiate with China with caution. They are a big economy, obviously. Our exports to China are nothing compared to what we import from there. So we need to negotiate with China very cautiously. Again, if you remember, that was one of the reasons we stepped back from ROTTEP, the large-scale treaty agreement, which is across ASEAN countries, Australia, New Zealand, and China, simply because of the fear of what Chinese goods how they can exploit the trade agreement if such a trade agreement was there.
Got that, Mrs. Shah. Useful conversation and gives us a roadmap on how to think about these negotiations as they proceed. Really appreciate you coming on this morning on CNBC-TV18. Thank you for your time, sir. Appreciate it.
Thank you very much. Thank you.
Thank you. I think just a quick look at the market, 450 points, 22,850. And overall, it's 10:1 in favor of advances if you look at the NSE market-wide breadth. Nigel.
Well, it's a beautiful looking screen, actually, because we started off with a gain of around 270 to 80 points, and we're built on those gains. You like a market like this, but now we're approaching that crucial zone where we have resistance. That's around the 20 DMA, which is 22,900 or thereabouts. So need to keep an eye out on that. And the Nifty Bank, by the way, is at the 200 DMA, which is the other crucial mark that we're tracking out there. Let's move on though. Global uncertainty has hit crude oil prices. Crude oil globally has fallen to the lowest we've seen in the last 4 years. Is there more further downside for crude prices? We also have domestic news with the government increasing excise duty on petrol as well as diesel, but they've also gone ahead and hiked LPG cylinder prices by around 50 rupees per cylinder. To discuss all this and more, we're joined by Mr. Surana, the former CMD, HPCL, and also joined by Mr. Gaurav Moda, the partner and energy sector leader, EY, who joins us. Hi, gentlemen. Good morning, and thanks a lot for joining in. Well, Mr. Surana, let me come across to you first. The oil minister says that OMCs normally carry inventory for around 45 days or thereabouts. The question is, maybe by May, should we be bracing for a price cut in petrol as well as diesel?
Good morning to you and Mr. Gaurav and all of your viewers.
Morning.
So there are three aspects which we need to consider before we reach to this judgment that after the inventories are over, whether we should expect another price cut or something like that. If you remember the past discussion which we had and the past narration, there are under recoveries on some products. There are over recoveries and under recoveries simultaneously happening at different points of time in some products. One may try to infer that there is a cross-subsidization of products. Probably that is right. But India is a heterogeneous country and there is no one-fit solution to that effect. The increase in the excise duty or increase in the LPG price, while it may look an antithesis on the first glance, but it looks perfectly logical because the volume share of the different products, let's say MS, HSD, and LPG, is not the same among all the market players. There are some companies who are not in the LPG business, but they have the MS, HSD volumes. So we can't have a situation where there is somebody who is a beneficiary of the margins, higher margins on some products, and some companies only are bearing the under recoveries on the LPG. So the way the government has thought of increasing the excise duty and not passing on to the consumer, it's a smart solution in my opinion, which has got something for all the three stakeholders, that is the consumer, the companies, and the government. Now, it also solves one issue that because we are incidentally in the April month and any downward revision, the price would have led to inventory losses also. So that solves that problem also without allowing the companies to continue to retain the higher margins on these two products. Now, come May, whether it should be reduced, it will depend on two things. One thing is the base objective of covering the under recoveries, which the minister has said that 41,338 crores, whether that has been reasonably reduced, number one. Second, how the oil prices and the product prices behave in the international market, because all said and done, the prices have not been aligned to the international markets over last few years. So these two components should decide, and the third part will be that the OPEC's move on the crude prices, because as we have seen, they have accelerated the rollback of the voluntary production cuts, which they have done earlier, and almost what the production should have come in July has come. But also then we should expect that the prices should be heading downwards.
You expect globally crude oil prices to head further south?
Yes, I would say that. Of course, it did touch 60.89, I think the lowest thing, and has come back to 63 point something today morning. But I think I don't expect it to go beyond 7. So the base, which was in the range of 75 to 80 earlier, I think it is shifted to now 65 to 70 or 60 to $70 in the near future. And that can be seen with the market structure of the derivative market, where in the Q2 and Q3 of 2025, we see a reasonably supplied market.
Okay, all right. Just to clarify, sir, you said that, it's perfectly logical what the government has done. That's hiking their excise duty as well as hiking the LPG prices as well. Do you expect another price increase on LPG? And do you expect them to deregulate it?
If you would have heard the minister's press conference, he did mention that from July 23 to February 25, I think there is a 63% increase in the international prices. So as of today, this 50 rupees increase is not covering the under recoveries which are there as of today. So even now, there are continuing under recoveries. That 41,338 crore was the past under recoveries which has got accumulated. Now so this increase will cater to part of that under recoveries for the phase which we are going in. But still you will have some more under recoveries coming in. But it is a reasonable solution where the 2 rupees increase on MSHSD, where the margins are reasonable. That covers, I was told that 32,000 crore or so in the will mock up, and 4,000 to I think 6,000 will come by LPG. But we still have got some component of the LPG under recovery which is ongoing because it is not covering the full market price.
Okay. All right, Mr. Surana, coming back to you, I want to ask you about Delhi's EV policy as well and what that could spell for the industry. But let's get in Mr. Gaurav into the discussion. Hi, Gaurav. Thanks a lot for joining in. Well, a lot of moving parts. Give us your take first, based on what's going on in the globe and also the government action.
Sure. I mean, very simplistically, as Mr. Surana has also mentioned, the global crude prices, which were averaging $75 to $80 per barrel, are now in the lower 60 range. So there's a 20% drop on averages. And this is reflected in the Indian crude basket as well, as we buy from Globe. So 20% drop is good for India, given we import almost 80%. But what that also means is some of this is to be passed to the consumers who've been bearing 90 rupees, 100 rupees per liter of petrol and diesel. At the same point of time, if you look at the back end, which is the refineries, and majority of the refineries happens in India, they will be under cost pressure. And therefore, cost optimization programs may get started to improve refinery margins as the crude prices come down. So it's a double-edged sword as far as the Indian oil sector is concerned. Good for the consumers, but the players need to see how they make money out of this.
Okay, all right. Mr. Surana, what do you make with regard to the New Delhi EV policy that they laid out? IGL is the one that gets most impacted because of the exposure they have to Delhi. Do you think they can go the distance and implement it?
The policy is still right now at the draft stage, so it needs an approval. And the Delhi narration of the pollution, I think, is slightly different than the whole of the country. So we cannot implement the similar solution all over India. But considering all the noises which we hear about the Delhi pollution and which comes every summer season, so targeting the two-wheelers and three-wheelers towards the EV, which is easier to do than the four-wheelers part, I think this may be one of the solution. But and because it is more towards the last-end connectivity of two-wheeler, three-wheelers. So this is a move in the right directions. Now, to what extent it gets implemented and how quickly it gets implemented, we need to see, because what is being said is that the new two-wheelers will not get registered about after 15th August 2026, which are not EV, and the three-wheelers beyond 15th August 2026. And there is a plan to, over a period, phase out the CNG run and petrol run and diesel run two-wheelers and three-wheelers.
Okay.
So let's see how what fashion it comes ultimately. And
Got it. Okay, all right, Mr. Surana, before we let you go, I wanted Gaurav's opinion as well. What do we see next? Another hike in excise duty from the government on petrol as well as diesel? Or do we brace for a cut? Because that will be of interest, not just to the shareholders, but also to the common man. Gaurav?
Yeah, I think before that, just a quick perspective on the EV view. If you look at the total transportation fuel in the country, almost 50% of that is diesel, 20% is petrol. Now you're looking at most of the EV impacting the 20%, where almost more than half of it is two-wheelers and less than half is four-wheelers. Effectively, all the conversation we're having on EV is on the 20% bracket, and within that on two-wheelers, which is 12% of the overall transportation fuel. 50% of transportation still sits on the trucks, and majority of that is the large trucks flying on highways. Unless we come up with a solution on the diesel side, which potentially may be hydrogen fuel cell in distant future, EVs will have a certain impact within the city, but not beyond a point.
Okay, all right. And you want to give me the answer to the other question that I asked you? With regard to what do we expect, excise duty hike or a petrol price cut?
Difficult to comment on that, on government policy. But the government has shown in the last 8 to 10 years that they want to keep the market stable, and therefore sometimes excise cut to manage price hike versus excise increase to manage crude oil prices coming down is the balance that government needs to maintain. Overall, a 20% decrease in global prices should reflect somewhere to some extent. In fact, even if you look at the global forecasts for crude for the next 18 months, it's downwards. So somewhere it'll reflect. How much we'll have to see, how to best balance.
Okay, all right. Thanks a lot, gentlemen, for joining in and giving us your perspective. Wishing you all a good day ahead, and we look forward to chatting up with you all again on the show as the entire situation does evolve globally as well. Wishing you all a good day ahead. Well, the markets are holding well in the green, 450 points, no worries on that front. The breadth of the market as well is as good. So it's a good start. It's a good Friday morning. And when we started off this week, the fear was of that Black Monday. Well, that's not really taken place. And in fact, we could possibly end the week more or less flattish, which will be a good outcome. Let's focus on a couple of stocks. Vinny's here to tell us about the pharma names, Sun Pharma as well as Cipla. Vinny, take it away.
Hi, good morning. So Sun Pharma, we've seen that it's opened up in a green, holding on to some positive side. Why? Because now it has got a positive news flow coming in for the Lexelvi drug. There was some court case that was going on. US Court of Appeals for Federal Circuit has ruled in favor of the company. So the preliminary injunction, this was there, that has been lifted. So now they can launch this drug. Yes, the court case is still going on, but they can launch the product coming in. The company had mentioned also in its con call last time that this could see a launch coming in as soon as they win this. There would be a launch in the next 2 to 4 weeks. So yes, we could expect that coming in the next month or so. Now, obviously, do not forget the patent for this drug is ending in December 2026. Analysts are highlighting that this is a very big positive for Sun Pharma. $400 to $500 million sale is what one could expect from this drug as a peak sale coming in, and EBITDA of around 50%. So very positive news flow coming in for Sun Pharma. Other one, Cipla, that's a positive news flow as well. They've received a US FDA approval for generic Abraxane for their company, which is used for the treatment of breast cancer. Now, this product was expected to be launched in the second half of FY26. This is a positive surprise that has come in, given that the US FDA approval has come in now, and they will be launching the product soon, H1 FY26. Now, Elara has also already penciled in a $20 million revenue for this in FY26. Currently, there are 4 other players, 3-4 other players who are there in this as well, but a big positive for Cipla on this front as well.
All right. Thank you very much for that, Vinny. Muthoot Finance is the stock which actually is selling off. Ritu is here with the changes the RBI has made with regards to gold financiers. Ritu, morning.
Good morning, Prashant. 98% of Muthoot's AUM is gold loans. So yes, it is one of the most impacted. But the headline from these draft rules really is they're not as bad as feared, although there may be some near-term impact. Now, what do the rules, the draft rules say? For bullet repayment consumption loans, the tenor has now been capped at 12 months. They also say gold now has to be valued at 22 carat purity. LTV changes or loan-to-value changes are some of the most significant that will impact NBFCs like Muthoot. Now, what RBI has said is that this 75% LTV has to be maintained throughout the tenor of the loan, something that was already applicable to banks, but it is now been made mandatory for NBFCs as well. The other additional factor is that the accrued interest has to be factored in when calculating that 75% LTV ratio, which means, at the time of sanctioning of a roll, you can't, the dispersal amount cannot breach that 75%, including the interest that was to accrue. So the origination LTV may actually actually have to be brought down lower. And if this breach in LTV continues for 30 consecutive days, there's also a 1% additional standard asset provisioning that will apply. So what it really does is reduces the arbitrage between NBFCs and banks, which is why you're seeing the likes of Muthoot getting affected. Now, brokerages say that this can affect growth in the near term, immediately after implementation, but they also say the outcome is slightly better than expected because, for instance, markets were talking about people in the street were talking about bullet loans itself being scrapped. Morgan Stanley believes Muthoot's countercyclical business can still ensure strong earnings, building in an ROE of 20% for this financial year, 18% for next financial year, and CLSA says this will be marginally disruptive for Muthoot and is building in a loan growth of 12 to 15% over this year and next.
All right. Thank you very much for that. The stock tag there, of course, is Manappuram. But just look at Muthoot and what that is doing. 5.5. So it's off the lows by about 1.5%. Ritu, thank you for that. Mitesh is with us now with what he'd want you to do in terms of specific trades. Mitesh, over to you.
Yeah. Prashant, the market is quite good. And I think, we're just holding on. We're not actually selling off from 22,800. So still, trading with some long bias. Grasim is something which I would recommend a buy. Keep a stop at 26.20. Look for targets of 26.80 to about 26.90. And Paytm is another one which opened a gap up and sustaining. So we'll take a very tight stop at 8.20 or just 819 here and look for a target of around 8.55, 8.60.
All right, Mitesh. Thank you for that. We'll speak again soon. Appreciate it. Well, we'll take a quick break. Back on the other side. Okay, welcome back. We've been talking about stocks and equities all day, but let's talk about commodities now. And of course, gold is glittering once again, bouncing off very, very sharply over the last 2 days. Manisha, take it away.
Oh, well, absolutely. There are various concerns in the international markets right now. And even as the equity markets have gained today, gold is not left behind. We're looking at all-time highs coming in and continuing for the gold prices. $3,200 an ounce is a level that we've been talking about for a very long time in this year as an year-end target. But there you have it. 32.20 is what we've seen in the Asian markets, in the markets today itself. So with this, gold is on track on best weekly gains since November 2024. And we also have seen gold prices hit all-time highs, not just in the US dollar terms, but in the Indian rupees, where we are trading above 92,000 rupees. Gold is also trading at an all-time high in Japanese yen, Australian dollar, Euro, Chinese yuan, all of those currencies as well. Very strong gains continuing, and that's also on the back of the US dollar index, which is trading at a 3-year lows. That clearly has been supportive for the gold buying there. The markets also are looking at strong ETF investments globally. Those numbers have continuously seen inflows for the last couple of quarters, and April has started no different, and that has been supportive. Well, the markets are looking at escalating US and China trade tensions with various tariff missiles being thrown on both the countries, and that has been bothering. Tariffs on China is now 145%, and China tariffs on US now stand at 84%.
There have been various calculations from various sectors on what it would really mean in sense of businesses between US and China, where the costs have gone up really high. So the inflation concerns has been one of the reasons that we've seen gold prices continue to do quite well there. Well, there are bullish cues coming in from the US markets itself. The US March CPI data that came in yesterday has been on the lower side, pushing for a rate cut as early as for the month of June itself. And then it also has been about the high US national debt. $34 trillion is what we saw passing in the month of November itself as an all-time high, and it only has grown since then. That has been supportive. The markets also are looking at COMEX gold holdings, which are also near record highs. The markets have been buying ahead for eventuality like this one. So strong buying continuing on physical markets and investment buying as well. The next chart should tell you on what the global banks and brokerages now believe that the gold prices can go up to. Well, 3,000 almost done, 3,015 also done. Deutsche Bank has talked about 3,140. And in extreme scenarios, they've talked about 3,700 on the higher side as well. That's going to be a level to watch out for. 3,200, again, we are standing at those levels as being put by ANZ and UBS. Remember, these banks had put these targets for the second quarter or the second half of this year. We already have seen that happen. Now the higher targets. Goldman Sachs has talked about 3,300 and 3,350 is what Bank of America is talking about. Citi says if investment continues stronger and there are extreme chances, you could be looking at 3,500 into this year as well. De Beer has talked about 3,300 and an eventuality can take the prices to 4,500 on the higher side. And this, the last one, is the most bullish of all until now. This comes in from Swiss Asia, where they say they're anticipating gold prices to continue to gain in the next 2 to 3 and 4 and 5 years as well. They have a gold target of $8,000 an ounce until 2028. Well, so everywhere that you look, we have banks revising their gold targets on the higher side, and it continues to be very, very bullish.
You know, Manisha, $8,000, we're at 3,000, right? 3,000 to 8,000 in 3 years.
Yes.
That is almost a 40% CAGR return, 40% compounded.
And if you look at the last 1 year, it's gained up by 40%, Prashant. So we've seen gold prices gain up by 40% in 1 year. This is about 3 years of a target. So,
and you know, we'll see. But it is absolutely the go-to in that sense, a safe haven, and so many other reasons why gold's been doing well. Time for a quick commercial break here. We're going to come back. Special segment. It's the economy. Latha in conversation with Brian Colton, Chief Economist of Fitch Ratings. We discuss what else, but Trump tariffs, the pullback, the pause, coming up.
Welcome to It's the Economy. US President has once again thrown a surprise at global markets by pausing the tariffs. Of course, globally, stocks have responded enthusiastically. But does that improve the prospects for global growth? Does it decrease the fears of recession? For some of these basic questions, I have with me the chief economist of Fitch Ratings, Brian Coulton. Brian, thank you very much indeed for joining us today. The world and investors all round are confused. What's your first impression with the tariffs being paused for a good 90 days? Does it improve the prospects or at least reduce recession fears?
It probably improves the prospects relative to the beginning of yesterday. But big picture, this has been complete chaos, and clearly the market adjustment has been too much for the White House team to bear. And particularly, I think the volatility in equity markets was something that they seem to be able to stomach, but the bond market sell off in the last 48 hours, I think, was something that was probably quite a concern. So, it's been a kind of dose of sobering reality, really. The rules of economics still apply, and you can't make these very, very aggressive policy changes without markets getting really concerned about it, and without real material impacts on the outlook for the economy.
Okay. Well, since you touched on the bond markets, can you explain a bit? The chatter across all markets, all major markets, is that it was the spike in bond yields to 4.5% and the devolvement of the US Treasury auction on Tuesday that rang alarm bells. Can you just connect the dots for us?
Yeah, I think the context here is the US government is still running a very large fiscal deficit, despite the economy having been very strong the last two or three years. And so the backdrop is that the market, concerned about the amount of supply that it's going to have to absorb. Remember, the Fed's no longer buying. They're not reducing their portfolio bonds quite so quickly. Maybe even pausing it for a little while. But that's the backdrop here. And when you see this sort of volatility, one other key development, I think, has been that if you look at the ownership structure of US Treasuries, we have an increasing share of what you would call like non-traditional holders there, in terms of sort of pension funds, insurance companies, more hedge funds, more money market mutual funds, more sort of slightly more flightier money, and I think that has been something that's created volatility. Normally when the market generally and the media generally is talking about a rising US recession risks and slower growth, what happens is that bond yields go down. So the fact that they started to go up pretty rapidly, I think, was a shot across the bows and was a signal that the market is concerned about supply. We had evidence of that in the last 12-18 months. Other occasions when the Treasury has raised their borrowing requirement, we've had a rise in bond yields, got nothing to do with the outlook for the economy going in the opposite direction. So I think it was a bit of a shock.
Okay, but what do you think caused that buyer's strike on Tuesday and even Wednesday, for that matter? Yields, even after the president announced that he's pausing the tariffs, didn't quite fall below 4%. They are still high. So what is causing the buyer's strike? Is it these short-term hedge funds who are now scared that there may be immediate inflationary fears? Or is it, the big buyers? Japan holds over $1 trillion of US Treasuries. China owns $760 billion from the last data I picked up from the US Federal Reserve. Are these people striking?
I don't think it's possible to sort of to tell. I mean, I know that's been the narrative, and clearly, central banks in Asia are big holders of treasuries, and the trade war, naturally leads to this speculation that there might be some sort of buyer strike. But this is a big and very, very liquid market. We just don't have the information to know if that's what happens. I think maybe a more credible story is that these non-traditional investors, which include hedge funds, they're leveraged investors, and we know they've been taking positions on something that's called a basis trade, the difference between the synthetic bond yield from the swap market and the cash bond yield, and with the volatility in the market, those leverage positions have been exposed, and I think there's a lot of market commentators that are following the market in detail a lot more closely than I am, but there seems to be this story that there's been an unwinding there related to the leverage positions, and this has been something that we've seen before in the March 2020 sell-off in the bond market, when with the outlook for the economy was collapsing under the pandemic shock, and we actually saw bond yields rising back then. The Fed had to step in, so we know this unwinding of leverage positions is an issue, has been an issue in the past, and there does seem to be some credibility to that story, that this was part of what was going on in the last 48 hours.
Yes, we did hear the chatter about this basis trade and, over-leveraged positions there. But to zoom out back into the global economy, what's your base case now? Will tariffs come back in some fashion? Will it remain this 10% which has been imposed on all countries? And what may be the consequences of that? Are we going to see, nevertheless, a recession in Europe or a slowdown in Asia? What is your base case?
I think the only thing you can say with complete certainty is that under this US administration, we're not going back to anything like the US trade tariffs that we saw before they came to office. So the US effective tariff rate was 2.3% at the end of 2024. Now, depending on what you assume, it looks like we're in the region of somewhere between 25 and 30% now. That's a massive change. Even with the 10%. The 10% rate rather than the additional reciprocal rate on all those countries that got hit with the additional rate on Liberation Day, even with that going back to 10%, because he's pushed the China rate so high, and China's a huge trading partner. We're still at 28-30% is the number. That's a massive change, and that is going to have definite negative impacts on US and global growth. Now, whether we get an outright recession in the US, 2 days ago that was looking pretty likely. I think the pause has probably reduced that likelihood a little bit. One thing you do need to remember is that the US government is going to get quite a lot of extra cash as a result of the tariffs. It's not going to be possible to shrink the volume of imports that quickly. So the higher tariff is going to lead to some additional coffers, maybe in the hundreds of billions of dollars. Now, is the US government going to save that money? So that's a direct drag on the economy, or are they going to recycle some of that money back into the US economy? And I think it's probably more likely to be the latter. So we'll see those extra tariff duties used to fund some tax cuts.
Well, before I run out of time, how would you look at it from an India point of view? Our own exposure to the US in terms of exports is only 2% of our GDP, and we are unlikely to lose all that in terms of markets. But will you have to mark down our growth because of an overall global slowdown?
Well, you're right in saying India's not such an open economy. I mean, the US is a pretty important market of the exports you do. I think it's a pretty big chunk of India's export base, but exports are not that large a share of the economy. So that's certainly true. Relative to some of the other countries that got hit with the other countries that got hit with the reciprocal tariffs, it's much less. It's a much bigger deal for a place like Vietnam, for instance. But we're talking about relative losses here. Even if it stays at this 10%, with the pause that we've got, even if it stays at 10%, 3 months ago, a 10% US tariff on China would have been seen as an absolute shocker, right? So you got to keep that perspective. I guess what's in India's favor is that they, access to the Indian market is something that I think the US administration would see as a highly valuable prize. So there is definitely something for India to offer if they are prepared to bring down those tariff rates, which are obviously much lower than the numbers the US published. The 50% they published is kind of based on some kind of fantasy economics, but even so, it is quite high. The MFN rate is 12%. So if there is a bilateral trade deal which brings that down, I think you can see prospects for some sort of negotiation there. So India may be, I wouldn't say a relative winner, but maybe I don't think there's any winners from this trade war, but it may not lose out as much as some of the other Asian countries that got whacked with the reciprocal tariffs.
Okay. Well, the Reserve Bank of India announced its own forecast of GDP growth this year, and they have brought down the GDP growth forecast by only 20 basis points from 6.7% earlier to 6.5%. You think there's the downside risk?
We haven't reworked our numbers on this, but yeah, there are some countries where we'd be looking to bring down growth by quite a substantial amount. I think India is sort of at the lower end of the spectrum. So yeah, quarter point, that sort of range doesn't off the top of my head seem completely out of line.
Okay. Finally, would you expect a currency war? We did see China's the PBOC adjust the fixing lowest in a couple of years, we are told. So do you think that there can be competitive devaluation? Is that a danger?
It's certainly a danger. It's certainly not my base case, but if China's looking at ways to offset this really dramatic, super aggressive US trade policy approach, and they wanted to support, their export sector and enable them to gain market share in the rest of the world to offset that, the shock to that $500 billion of exports that go to the US. Slashing the RMB against the US dollar would make sense from an economic policy perspective. If they were to do that, that would unleash a huge amount of volatility in the emerging market currencies. I